As an equity investor, it's really important to be aware of the sorts of factors that influence your returns because they vary from stock to stock. So when you're putting together a portfolio of diversified stocks, you don't want all your eggs in the same basket. And debt is one of the key factors that can influence equity returns. So in this short video, I want to show you how it does it. I want to show you the good news and the bad news. So a quick introduction, first of all, the basics. Firms normally have two sources of finance. They can borrow from banks and or bondholders and so on, or they can ask their shareholders to pump in money. They can bring in outside owners. And those are your two basic choices. Now, debt has a number of advantages. First, of course, you don't have to invite anyone else in to own your business. It's also usually cheaper. You can do things like securitized debt, offer security, for example. It can boost returns to shareholders. I'll show you that in just a moment. And it's relatively tax efficient. The tax, I'm going to leave to a future video. There are one or two tax benefits to having debt in issue. However, nothing's a free lunch in investing. So whilst debt can boost equity returns quite nicely, it can also increase balance sheet risk, which translates as volatility. And that's something to bear in mind. I want to show you both sides of the debt coin. So, first of all, how debt helps. Let's take a very simple example. Two companies, A and B. They're the same size. What I mean by that is they have balance sheet assets in millions of 100 each, but the financing of those assets is different. A has 50 million of debt and 50 million of shareholders' equity. So if you like, lenders have put in half the money, shareholders have put in the other half. B has no debt. All right? And that means that B, to use the jargon, has no gearing. All right? There is no debt. Whereas A, if you are doing debt as a proportion of total assets or total funding, is around 50% geared. Just use it, or leverage, just use the American jargon there. So what? Well, let's take a look now at the following periods. That's the start of the year, that's where they start from. Let's take a look at what happens for the next 12 months in terms of performance. So they both make a profit of 25 million. But A has got to fund some interest on its debt. Now I've assumed maybe a slightly higher rate of 10%, just to keep the numbers round. So A has got to find 5 million of interest, reducing its profit after interest to 20 million. B also makes 25 million off the same size of asset base, but no interest on debt, result 25 million. Now here's my point, okay? First point I'd make is looking at these numbers, I might ask myself the question, can A afford all this debt, 50% gearing? Looks like they can, based on the result for the following 12 months, because if you were doing a quick snapshot of how many times A's profit before interest covers its interest bill, 5 times, not too bad. So A can afford the debt it's carrying at the moment, B doesn't have any debt. But here's the point, who would you rather have been invested in? I haven't answered that question so far. Who would you rather be invested in? If you were to look at the return on total opening capital, you'd be hard pushed to select between the two, because 25 as a proportion of 100 is 25%, and 25 as a proportion of 100 is 25%. But as an equity investor, that's not the most relevant calculation. The relevant calculation is the return to you, the return on equity. Now the picture changes, because profit after interest of 20 million as a return on 50 is 40%, whereas B can only offer 25 over 100, which is 25%. Now that's return on opening capital. If you're a fan of return on closing capital, some people are, there's no absolute hard and fast rule on this, then A still offers a better return to its equity investors, because 20 as a proportion of 70, that's 50 plus the 20 profits belongs to shareholders, is better than what B's offering, okay, which is 25 over 125. And if you're wondering what those numbers actually look like, here we go. So A, return on opening equity 40%, plays 25. In other words, you're better off as an equity investor in A, thanks to the gearing, thanks to the leverage. B, closing equity 29%, plays 20%, so you're still better off as an equity investor in firm A, if things go well, if the firm generates lots of profit. But there's a downside to gearing, downside to leverage, and it's this. What if profits are nothing like as impressive as they were in the last example? So, how debt can hurt. Same starting facts. A and B, 100 million assets. A with that 50% leverage or gearing, B no debt. Now, let's do the next 12 months results. Much less impressive here. So we've still got 50% leverage. Now that's debt to debt plus equity. Some people prefer to do it another way, but that's fine. So I'm going to call that 50% leverage in A. Now look at the interest cover. Both firms only making 7 million. Interest takes out 5 of that for A to leave 2. No interest for B again, no debt. So the interest cover is a much more hairy 1.4 times. B hasn't got to worry about interest cover because there is no interest to cover. Okay, so I'll be asking the question already, should A really carry that amount of debt? 1.4 times cover. It's a bit like the question, if you borrow to fund a property with a big mortgage, how many times does your salary cover the interest? If you were A, you'd be feeling a bit nervous. But leaving that to one side, there's another problem, which is the return to equity investors in A is less impressive now, because once they've cleared the interest, 2 as a proportion of the initial equity investment of 50 million is only 4%, whereas B can offer 7 over 100 or 7%. So on an opening capital basis, B now offers a better return, and on a closing capital basis, B also offers the better return without the debt or leverage. And here it is. All right, 4% on the left plays 7% on the right. That's A and B respectively. 3.8 plays 6.5 on the right. The point being that now the debt or leverage, if you like, is acting as a bit of a drag on A's results, whereas previously it actually boosted them. Okay. So in this short, sharp video, hopefully I've shown you that debt matters. Debt influences the overall return you make as an equity investor. And I've just introduced, build on this in future videos, 3 ways of assessing the impact that debt is having on a business. One is to look at the return on equity. Second one is to look at the overall level of gearing or leverage. And the third one, interest cover. Future videos, I'll take those themes further.